Most traders are staring at the 5% crash in Brent crude and thinking the move is over. That's exactly the kind of thinking that gets you run over. There is one danger zone and one hidden opportunity today, and I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now, including a high-risk setup that targets the dead cat bounce nobody believes in right now. Brent is trading at 92.94, and the overnight action has been brutal. The tape is painting a strong sell on every single time frame. Monthly, daily, 5-hour, 1-hour, all screaming downward momentum. When you see alignment like this, the market isn't suggesting a pullback. It's demanding you respect the trend. But here's what most traders miss. The weekly chart hasn't flipped bearish yet. It's sitting at neutral, which means this sell-off is either a massive bull trap correction or the start of something much bigger. That ambiguity is exactly where the money is hiding. Here's my instant market verdict. Today's session bias is bearish, but we are approaching a structural edge that can snap this move into a violent reversal. The invalidation level that turns this from sell the rip to buy the dip is 91.30 on a daily closing basis. Write this number down. If we break 91.30 and hold below it into the daily close, the whole structure shifts from a correction within an uptrend to a full-blown trend reversal targeting the 80s. If we don't break it, this is a trap, and the snapback will. Rip the faces off late shorts. Let's go top down and walk the chart like an institutional trader. On the weekly time frame, Brent carved out a double top pattern around 98.20 to 99.73, levels that now act as a fortress of resistance. The 50-week moving average is trying to hold around 98.71, but price has violated it. The weekly MACD is curling over, but we are not seeing a hard cross yet. That's exactly why the weeklies are neutral. If this week closes below 92.83, the weekly trend flips to sell, and the momentum chase will accelerate, drop down to the daily, and the picture gets uglier. The daily trend is strong sell. The 20-day moving average at 101.30 has rolled over, and we've sliced through the 50-day at 98.71 like it wasn't even there. The 100-day moving average is all the way down at 91.49, sitting just above our critical support zone. That's important. The 100-day is acting as a magnet, but more importantly, it's the last line of defense before the 200-day at 82.74. The daily MACD is printing minus 1.86 and accelerating, with no sign of convergence. Sellers are in control, and the RSI at 40 tells you we are not oversold yet. There is room to fall. Now the 4-hour chart is where the execution sits. We are range extended below the 20-period and 60-period Mars, and the 200-period on 4H is way above us near 101. That means any rally attempts are selling opportunities until we reclaim something north of 98. The MACD on 4H is deeply negative, but it's starting to flatten slightly. That tiny flattening is the seed of a potential bullish divergence, but it's not confirmed. Do not front-run it. On the 60-minute chart, we are consolidating just above 92.83 with lower highs. The 5-hour and 1-hour trends are both strong sell, so intraday pops are short-lived. The order flow is selling every tick up. Let's stitch in the crosser-set narrative, because crude never moves in a vacuum. Gold is the fear architect, and right now gold is holding firm above its key supports while crude collapses. That divergence is screaming one thing. This oil sell-off is not a macro panic, it's a supply-side and demand worry event specifically hitting energy. If this were a broad-based risk-off collapse, gold would be surging, and the S&P would be getting hammered. Instead, we are seeing a rotation within the commodity complex. The geopolitical premium that was baked into crude from the Middle East tensions is being unwound as Iran deal talks gain traction. The market is pricing in a potential return of Iranian barrels, and that supply shock narrative is the actual driver. Crosscheck gold. If gold suddenly spikes and oil continues to fall, that's your macro fear confirmation. But if gold stays steady, this is a crude-specific deflation of risk premium, and the dip buying opportunity after the panic can be ferocious. The fundamental driver is clear. In the last 24 hours, Oil settled 5% lower as investors awaited updates on US-Iran peace deal talks. That one headline changed the entire sentiment structure. Beyond the geopolitical angle, we are also seeing profit-taking after the run-up, and consumer demand worries are creeping in as global PMI numbers hint at slowdown. The narrative is shifting from tight supply to maybe demand isn't strong enough to absorb even current supply, let alone additional barrels from Iran. That double whammy is what crushed price. My 1 to 2 week directional lean remains bearish below 98.20. The thesis invalidation is a daily close above 99.73. If that happens, the bear case is dead and we are back to range-bound consolidation with an upward bias. But until then, selling rallies is the path of least resistance. Now, this is where most people click away, but this is where money is made. Keep watching. I'm going to give you 3 trade setups, precise numbers, stop losses, and risk-reward logic. Strategy 1, the sniper, conservative. This is for traders who wait for confirmation and want high-probability entries. The trigger condition is a clean 1 hour close below 92.83 with a MACD histogram print lower than the previous bar, that confirms momentum is accelerating through support. Entry is a sell stop at 92.75. Stop loss goes at 93.50, which is above the intraday consolidation high and the broken support turned resistance. That's a 75 tick risk. Target 1 is 91.50, just above the 100-day moving average and our key support zone. That's 125 ticks of profit, giving a risk reward of 1 to 1.67. Target 2 is 90.00, a psychological level that aligns with previous structural support from 3 months ago, yielding over 1 to 3.5 risk reward. Void this setup if price pushes back above 93.50 before triggering. We do not chase. The sniper waits. Strategy 2, the active trader, standard. This capitalizes on mean reversion to the moving averages in a trending market. Entry condition. Watch for a 60-minute rally into the 94.80 to 95.20 zone, where the declining 5-hour and 10-hour MAs are converging. Once price stalls and prints a bearish engulfing candle on 15-minute, you go short. Entry at market after that candle close, around 95.00 with a stop loss at 96.20, above the 20-hour MA and yesterday's high volume node. That's a 120 tick stop. Target 1 is 93.20, just above the overnight low, for 180 ticks. Target 2 is 91.80, near the 100-day moving average, for 320 ticks. Once target 1 is hit, move the stop to break even and trail by 50 ticks. This setup exploits the active trader who knows that the first bounce in a strong trend is a gift if you have the patience to wait for the retest of the breakdown zone. The logic: the market needs to refill some orders before the next leg down, and you're positioning in the path of institutional algorithms that reload shorts. Now, let's see how aligned we are. Type your Brent oil range for tomorrow in the comments right now. High and low. I'm reading them, and I'll pin the closest one. Strategy 3, the Aggressor, high risk. This is a counter-trend reversal attempt for those who know how to lose small and manage risk aggressively. The setup: if price spikes down into the 91.30 to 91.50 zone on a single 5-minute candle with massive volume and RSI below 25, we fade that panic. Enter long at 91.40 with a tight stop at 90.80, just below the 91.30 support and the 100-day moving average. That's a 60-tick stop. Target 1 is 92.50, a minor resistance and intraday mean, for 110 ticks. Target 2 is 93.80, which is the top of the overnight consolidation, for 240 ticks. This is a pure mean reversion trade betting that the Iran deal premium is over-discounted in the short term and a dead cat bounce emerges. The warning: if 91.30 breaks on a closing basis, this trade is dead and you must exit immediately. Do not add. This is a one-shot, small size, strictly managed play. Here's the risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like actual Iran deal statements or inventory data. Stops are non-negotiable. If the market gaps through your stop, you honor it on the next print. Live to trade another day. Let's zoom out and prepare for the next session. The single most critical level for tomorrow is 91.30. Everything hinges on that. If we hold above 91.30, the bull case survives and we could see a swift recovery toward the 95 area. If we break and close below, the trapdoor opens to 88 and eventually the 200-day at 82.74. Tomorrow's focus will be the continuation of Iran deal headlines and any inventory surprises. That catalyst can accelerate whatever technical structure is in play. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen. We are tracking the risk asset shadow, funding rates flipping, and a potential liquidity grab that ties directly into what Crude is doing. Smash like if this analysis gave you a clear plan, subscribe and hit the bell for daily coverage. I'll see you in the next one.